Ever wondered about the biggest stock market crashes in history? Well, you're about to embark on a fascinating journey. A stock market crash, in its simplest terms, is a sudden and significant drop in the value of stocks, which causes a major loss of wealth. These crashes can be triggered by a variety of factors, including economic indicators, natural disasters, and sometimes sheer panic. The impact of such crashes is often devastating, leading to recession, unemployment, and a slowdown in economic growth. But why are we interested in these financial catastrophes? Understanding the causes and consequences of past crashes can provide valuable insights, helping us navigate the uncertain waters of the financial world. Today, we will be exploring the biggest stock market crashes in history, their causes, and their aftermath. From the South Sea bubble of the 18th century to the global financial crisis of the 21st. So brace yourself as we delve into the biggest stock market crashes in history. Our journey starts in the 18th century with the South Sea bubble of 1720. Imagine a corporation named the South Sea Company, which had the seemingly golden opportunity to monopolize trade with South America. Investors were ravenous for a piece of this promising venture, leading to rampant speculation that drove the company's stock prices to dizzying heights. But here's the catch. The supposed gold mine was largely a mirage, as the expected profits never materialized. The bubble, as we now know it, was inflated by over-optimistic expectations and under-regulated financial practices. When reality hit and the profits failed to appear, the bubble burst. Investors who had poured their life savings into the South Sea Company's stocks were left penniless, and the British economy was sent spiraling into a severe depression. The South Sea bubble was a stark reminder of the risks of speculation and unchecked financial ambition. It was a financial disaster that would echo through the centuries, warning future generations of the dangers of unbridled financial speculation. Fast forward to the 20th century, we meet the infamous Wall Street crash of 1929. Picture a time of roaring prosperity. The 1920s, also known as the Roaring Twenties, was a period of enormous economic growth. The United States was booming, the stock market was soaring, and people were making money hand over fist. It seemed like the good times would never end. But they did. Behind this prosperity was a dangerous game of speculation. People were buying stocks on margin, essentially borrowing money to buy more stocks. This created an inflated market with prices that didn't reflect the actual value of companies. The market was like a house of cards, waiting for the slightest jolt to bring it all down. And that jolt came in October of 1929. In just a few days, the market lost a significant chunk of its value. Panic ensued as people tried to sell their stocks but found no buyers. This was the Wall Street crash of 1929, the most devastating stock market crash in the history of the United States. It led to a total loss of confidence in the American financial system. The fallout was immediate and far-reaching. Banks failed, businesses closed, and millions of people lost their jobs. The United States and much of the world was plunged into the Great Depression, a period of economic hardship that lasted for a decade. The Wall Street crash of 1929 was a stark reminder of the dangers of speculation and unregulated markets. It led to sweeping reforms in the financial industry, including the creation of the Securities and Exchange Commission to regulate the stock market and protect investors. But the lessons of 1929 are not just historical. They are a cautionary tale for today's investors, a reminder of the importance of understanding the true value of stocks and the risks of speculative investing. The Wall Street crash of 1929, a devastating event that changed the world and shaped economic policies for decades to come. Jumping to the late 20th century, we encounter Black Monday 1987. Now, this wasn't your average Monday. Imagine waking up to find that the stock market has plummeted a staggering 22% in just one day. That's the reality of Black Monday, a day that sent shockwaves through the global economy. Now, what led to this unprecedented crash? There were a few key factors at play, but chief among them was the relatively new phenomenon of computer trading. You see, back in the 80s, Wall Street had begun to rely heavily on computer algorithms to conduct large-scale trading. These automated systems were designed to sell stocks when they hit certain thresholds, to limit losses. However, on October 19, 1987, these systems triggered a mass sell-off. As stock prices fell, more and more trading thresholds were hit, causing the computers to sell even more stocks. This led to a vicious cycle of selling that only served to accelerate the crash. But the impact of Black Monday wasn't confined to Wall Street. It was a global event. Stock markets around the world, from Hong Kong to London, also suffered heavy losses. The crash exposed the interconnectedness of global financial markets, a reality we are all too familiar with today. In the aftermath of Black Monday, regulators were quick to step in. They implemented circuit breakers, mechanisms designed to temporarily halt trading during severe market downturns, giving traders a chance to catch their breath and hopefully preventing future crashes of this magnitude. But what does Black Monday tell us? Well, it serves as a stark reminder that no market, no matter how advanced, is immune to dramatic crashes. It underscores the importance of robust regulatory mechanisms and the risks inherent in relying too heavily on automated trading systems. So next time you hear the term Black Monday, remember October 19, 1987, the day the world's stock markets took a dive, shaken by the power of computers and the vulnerability of global economic interdependence. Black Monday, a day that proved even the most modern of markets are not immune to dramatic crashes. As we enter the new millennium, we are met with the dot-com bubble of 2000. In the late 90s, a surge of interest in anything and everything related to the internet created an explosion in the technology sector. Startup companies dubbed dot-coms began popping up left, right, and center, promising innovations that would change the world. Investors, eager to capitalize on the next big thing, poured money into these ventures, often without a clear understanding of their business models or even if they had a viable product. The stock prices of these dot-com companies skyrocketed, fueled by speculation and the fear of missing out. Traditional valuation metrics were thrown out of the window as investors banked on the potential of the internet rather than proven business practices. This created a bubble in the market, an overinflation of prices based on hype and hope, rather than tangible assets or revenues. But like all bubbles, it was destined to burst. And when it did, the fallout was spectacular. Many of these dot-coms, which had been valued in the billions, were revealed to be nothing more than ideas and potential. Without a solid foundation, they collapsed, leaving investors with significant losses. The impact of the crash was felt far and wide. It led to a recession in the tech industry and a loss of confidence in technology stocks. It took years for the sector to recover and for investors to regain their trust in the potential of the internet. But perhaps most importantly, it served as a stark reminder of the dangers of speculation and overvaluation. Despite the crash, the dot-com era wasn't all doom and gloom. It paved the way for the internet and technology giants we know today. Companies like Amazon and Google weathered the storm and emerged stronger, proving that with a sound business model, the internet did indeed have the potential to revolutionize the way we live and work. The dot-com bubble, a harsh lesson in the dangers of hype and overvaluation. Our timeline brings us to a crash many of us remember, the global financial crisis of 2008. In the early 2000s, a housing bubble was developing in the United States. Banks were offering what were known as subprime mortgages, loans given to individuals with poor credit who were at a higher risk of defaulting. The banks, however, were not overly concerned. They bundled these risky loans into mortgage-backed securities, spreading the risk and selling them off to investors around the world. As more and more people defaulted on their loans, these securities plummeted in value. Banks and investors who had heavily invested in these securities found themselves in a precarious position. Financial institutions began to crumble, and the fall of Lehman Brothers, a prominent global financial services firm, in September 2008, marked the beginning of the full-blown crisis. The effects of the crisis were far-reaching and swift. Stock markets around the world tumbled and economies went into recession. Unemployment soared, and millions of people lost their homes. Governments stepped in to bail out banks, fearing a total collapse of the financial system. In the aftermath, governments and financial institutions faced intense scrutiny. Regulations were tightened, and measures were put in place to prevent a similar crisis from happening in the future. However, the recovery was slow and painful. The crisis had eroded trust in financial institutions and governments alike, and the effects are still felt today. The 2008 crash was not just a financial crisis, it was a social and political one too. It highlighted the inequalities within societies and the flaws in our financial systems. It was a wake-up call, a stark reminder of how intertwined our economies are and how vulnerable they can be. And so we come to the end of our journey through the world's most devastating stock market crashes. From the South Sea bubble to the global financial crisis, we've seen how greed, speculation, and lack of regulation can lead to disaster. The 2008 financial crisis, a stark reminder of the interconnectedness of global markets and the devastating potential of financial crashes. As we conclude our journey through the biggest stock market crashes in history, let's take a moment to reflect on what we've learned. Time and time again, we've seen that the stock market is a volatile creature, subject to the whims of human emotion, global politics, and economic indicators. From the South Sea bubble of 1720 to the global financial crisis of 2008, these events have shown us that while the stock market offers vast opportunities for wealth creation, it also carries significant risks. The key takeaway? It's important to diversify our investments and not place all our eggs in one basket. It's also crucial to remember that the market is cyclical. Just as night follows day, periods of growth are often followed by downturns. And while these crashes can be devastating, they also offer opportunities for those who are prepared and patient. While the future of the stock market remains uncertain, the past serves as a reminder of the potential risks and rewards of financial speculation.